Hello, today we're talking about how you can make balanced strategic financial decisions. We believe there's 4 key ratios that you need to consider for every key decision to ensure that those decisions are well balanced and are going to be enhancing your financial position. Those 4 ratios are your GP percentage, your working capital percentage, your return on capital employed percentage, and finally it's your debt to capital ratio. So your GP, that is your gross profit divided by your revenue to give you your GP percentage. That needs to be pretty close to your target GP percentage in order for a strategic decision to move forward. So working capital percentage then, working capital is the money that you've got invested in your debtors, your creditors and your inventory or your work in progress. And it's all of that added together divided by your revenue. That gives you a percentage, and you really should have a target percentage. If a strategic decision is going to adversely affect your working capital percentage and take you beyond where you're targeting, then you should probably think about changing that strategic decision, because it is going to absorb an awful lot of cash into your working capital, and potentially that could close off other opportunities to you. The next ratio that's really important to consider is your return on capital employed. That's your EBIT, your earnings before interest and tax, divided by your opening capital balance. And you need to have a target around what your return on capital should be. It should certainly be higher than your cost of capital, and that will ensure that you're continuing to make economic value. If you end up making a decision that significantly reduces your return on capital employed percentage and it dips below your cost of capital percentage, that will mean that you are destroying rather than creating economic value. If you're not too sure about your capital or your EBIT or economic value, we've got videos on those, have a look at those. And the final ratio that you need to consider when you're making balanced strategic financial decisions is your debt to capital ratio. So debt is part of your funding, and the other part of your funding is equity. So to calculate your debt to capital ratio, what you do is you divide your debt by your debt plus your equity, your capital, and that gives you your debt to capital ratio. So you need to have a target ratio for your debt to capital. Now, some debt is obviously good, it enables you to realize and address certain opportunities, but too much debt in the business takes away a lot of the control, takes away the autonomy away from you, the owner of the organization. So we would never advocate that you have a debt to capital ratio in excess of 50% for a prolonged period of time. I hope that's been helpful. Any questions or comments, get in touch, and we'll be back very soon.